Aggregation management is essential for monitoring and controlling the accumulation of exposures across geographies and peril types, preventing significant correlated losses. For commercial and industrial property portfolios, effective aggregation management ensures balanced risk distribution and alignment with risk appetite. Key skills: understanding risk correlations, identify relationships between risks, such as properties in the same flood zone or dependent on shared infrastructure, to prevent amplified losses. Knowledge of geographical exposures, analyze exposure to risks like hurricanes, earthquakes, or urban density to predict potential losses. Risk quantification, calculate exposure metrics like total insured value TIV, probable maximum loss PML, and average annual loss AL. Portfolio metrics familiarity, evaluate metrics like tail value at risk TVAR for comprehensive risk assessment. Techniques: geocoding tools, map and analyze insured locations to visualize exposure concentrations. Identify high-risk zones like seismic areas or floodplains. Examples: GIS software, CAT modeling tools. Portfolio management software, monitor exposures across regions and perils in real time. Automate alerts for exposure threshold breaches. Examples: RMS RiskLink, Air Touchstone, Spatial Key. Stress testing and scenario analysis, simulate worst-case scenarios e.g., hurricanes or earthquakes. Use CAT models to estimate potential losses and adjust underwriting. Diversification strategies, geographic, spread risk across regions to avoid concentrations. Portfolio mix, balance occupancies e.g., retail, manufacturing, and perils to dilute risk. Reinsurance optimization, leverage excess of loss or aggregate treaties to cap losses. Retain manageable risk levels within internal limits. Accumulation reporting, generate reports regularly to track exposures. Set benchmarks for acceptable aggregation levels. Challenges: data quality, incomplete or poor data on locations or values can distort risk assessments. Solution: use data enrichment tools and enforce strong data collection standards. Dynamic risks, changing policy terms or new business can alter aggregation levels. Solution: utilize real-time monitoring systems for ongoing adjustments. Regulatory requirements, meet standards like Solvency II with accurate aggregation reporting. Solution: maintain transparent methodologies for compliance. Practical steps: develop risk maps, create heat maps of high exposure zones to guide underwriting decisions. Set aggregation limits, define maximum exposures for specific regions, perils, or occupancies. Collaborate with reinsurers, align on aggregation strategies to optimize treaty structures. Monitor continuously, use tools and software to track changes dynamically. Conclusion: aggregation management is crucial for controlling exposure concentrations, ensuring profitability, and protecting solvency. With the right tools, skills, and strategies, underwriters can effectively manage complex portfolios and mitigate potential financial losses.